Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
No signs of slowing down. Nvidia is on track to add $160 billion to its valuations after crushing outlook expectations. Treasury steady after a post-Fed minute decline. The latest log shows the central bank is in no rush to cut rates. And the U.S. Justice Department plans to sue Live Nation this week for antitrust violations related to Ticketmaster's control over ticket sales. Good morning, Manus.
Yeah, Danny, I'll welcome that. The price of a ticket to Taylor Swift. We'll talk about that in just a moment. It's almost like Oprah Day for chips, isn't it? Nvidia was more important, perhaps, than any monetary policy decision. And as you say, $160 billion is where we are at the moment in additional market cap. All boats are rising on the back of this. You've got AMD bid up as well. Now, we're going to debate with HSBC. What is the more significant thing? Is it the buyback, the dividend, the guidance? The guidance is supreme in terms of the second quarter and going forward. UBS also up their global tech earnings narrative to up 20% this year and 16% into next year. And I love what Andrew Slimmon says over at Morgan Stanley. We're in the FOMO moment. In other words, another record high in the S&P 500, but we're in FOMO. We've got this fear of missing out. It is not a drop in yields that will pull in liquidity there. The bond market is looking at a retrospective piece of information from the FOMC. The short end popped, and again, we're up by one basis point this morning. The view very, very clearly is that there's slightly hawkish tilt. Many question how restrictive rates were. And as you and I just discussed before we came to air, a variety talked about the willingness to tighten. So again, it's retrospective. It's before the CPI number. I thought we'd just throw in copper, Danny, because it dropped by 5% yesterday. I mean, parabolic rally that we've had. But demand destruction is kicking in China. They're pushing back at having to pay over $11,000 at one juncture for this copper. And in that respect, Danny, it is the manifestation of demand destruction. Good morning.
I love that you called this Oprah Day for chip makers. Like, you know, I'm going to look under my seat and there's going to be a dividend and now only, $100 stock there. Man, it's the thing I love about NVIDIA, all of the hype around it. And the hype is real, right? The earnings showed us this. But I love the excitement over an 150% increase in the dividend.
I love a banner headline.
It's peanuts. It was 4 cents.
We'll talk to the guests in a moment. Yes, it's only 4 cents, and you're right. It's not the size, but it's the direction of travel. And if you think of like the Meta dividend, the Google dividend, it's more a narrative about a shift in growth stocks. And where are we? Are we evolving into a slightly new era?
Yes. If just one more thing.
The
stock split. This I love, too, because every time a company has a stock split that's really expensive, the share price goes up. But if you believe in efficient markets, it shouldn't. But it just shows how much firepower is behind NVIDIA and how many retail investors want to buy the stock. And it's now a little bit easier to do so.
Well, a stock split is a democratization in many ways, and it will add to liquidity into the base. But let's talk a little bit more about NVIDIA and the AI boom. It's not going away. You've got this bullish forecasts igniting a rally, as Danny just said, of more than $160 billion in the aftermarket. Here's what the CEO, Jensen Huang, had to say about the earnings on the call.
The next industrial revolution has begun. Companies and countries are partnering with NVIDIA to shift the trillion-dollar installed base of traditional data centers to accelerated computing and build a new type of data center, AI factories, to produce a new commodity, artificial intelligence.
Let's get a little bit of context. Frank Lee, head of technology research over at HSBC, has a buy rating on the stock. Good to see you this morning. $1,350 is your target. We traded over $1,000 and bid. The question I have for you is, this is about getting beyond the 40% that delivers the main revenue. This is about growing and believing that NVIDIA can grow beyond Amazon, Microsoft, and Google. So this is very much a belief in the growth of the base. Good morning.
Hi, guys. So, yeah, I think if you look at, how the stocks reacted, it was another beat and raise quarter. But I don't think the magnitude of the beats weren't necessarily that significant. I mean, I think some of the buy-side expectations were largely in line. But what was really, I think, people are excited about the story is really about, the roadmap. I mean, if you look at the roadmap, one of the things that people are excited is this new Blackwell platform that's coming. And we think that's, Jensen just referred to a new type of architecture. That's exactly what it is. Next year, they're going to deliver this NVL rack architecture. It's going to significantly increase their ASPs, and that is going to be another year of potential upside relative to where the market is. So I think that is, what's really the exciting part. While people tend to focus a bit on the quarters, I think, the faith and belief is really not just a single quarter, but this story is going to continue to carry on for some time.
Help us mere mortals without the brain to understand AI, exactly what that means. Frank, is that going beyond, for example, the big hyperscalers, the Meta, the Google? Is this a product that caters to a wider universe of companies?
Yeah, that's a great question. I mean, obviously, I think last year, one of the concerns people had was that they're growing fantastically, but can they keep this up? Because the majority of their CapEx spend was the hyperscalers driving that growth. But I think what you've seen this year is that there's definitely an expanding market beyond hyperscalers toward the enterprise. So you've seen, NVIDIA recently talk about working with Dell. Dell's really, its strength is really in the enterprise market. So we're now talking about a bigger TAM beyond traditional hyperscalers. Now, the hyperscalers will still unquestionably be an important driver, but it's now they've got a much wider client base and application than I think what people thought a year ago.
And where are they in terms of being just so far ahead of everybody else in terms of catching up with them and developing their own chips? And it's essentially, I suppose, protecting their pricing power.
Yeah, I mean, I think if you look at what's happening is that, we have seen these hyperscalers looking at designing their own chip, what they call ASIC chips, application-specific ICs. And I think there was a belief that there would be an opportunity for them as they go into the second stage of AI from training to inference. But what we've clearly seen is that NVIDIA's roadmap has come out and continued to demonstrate their lead, and it's making it a lot harder for their competitors to try to narrow that gap. So it looks as though with the roadmap we see for the next 12 months, that gap's only going to widen instead of narrowing anytime soon.
So Frank, with that gap, cash on the balance sheet, $31.4 billion, up from $15.3 billion a year ago. We know partially how they're spending that with the teeniest little 150% increase you've ever seen to 10 cents a share. How would you like to see that cash spent? Do you want bigger dividends or something else, more CapEx? How does it make sense to spend that?
Well, I mean, it's a good problem to have because they're in a business where they really don't need to spend a lot of money. It's they're a chip company. All the heavy lifting in terms of CapEx is actually being spent by TSMC, who manufactures the chips for them. So essentially, it's a cash machine. So I think continue to increase your dividend payout will be a positive. There could also be, I think, more opportunities for any kind of investments and acquisitions. It's not too long ago where there was an intention to buy ARM, and so I think they could continue to be looking for opportunities to do that, or even invest in startups to develop their own customer base. So there's I think smaller CSPs they've invested in that are becoming more important clients now.
What is the secret sauce when you look at the concentration of demand for their product, but is there a concentration in terms of human capital at NVIDIA that the others just simply don't have? Are we at that stage of where all outstanding human capital really wants to work at NVIDIA relative to the other peers in development? Do they have that level of moat? What are the moats around NVIDIA?
Yeah, that's a great question. I think if you look at why they've been so successful is obviously they've been working on this for a long time. This AI story, while it feels like it just came out overnight, they've been working on these products for a number of years. And if you think about, they have largely not been participating in the whole smartphone and mobile product cycle. So I think they've had a long time to work and develop their expertise and hence create this moat that's going to be very hard for people to break. And so I think and now they're basically putting everything together. They've got an extremely strong moat when it comes to software as well. So it's not really a chip company. So I think one of the biggest takeaways is that it's not a semiconductor chip company in a traditional sense. It's becoming a system solution, all-in solution provider for AI.
Well, to that point, because 75.5% margin is insane if it is a traditional semiconductor chip company. I mean, that's a type of margin. I think Intel at the height of their margins only saw something in the low 60s, Frank. So 75.5. Do you look at that and say, okay, if they're transitioning away from just being a semiconductor chip company, they can maintain that kind of level of margin?
Yeah, that's the big debate right now because, while they are transitioning, the majority of their revenues are still based on semiconductor chips. And it is kind of an abnormal profitability that they're getting for relative to a semiconductor company. But at the same time, there's a lot of value in terms of what they're doing in terms of being a system integrator and a software company. I mean, I think people sometimes underestimate the extent of how that software mode is, and that also provides value added. But they're also driving, I think, beyond just the company itself, their whole supply chain, especially in Asia. You have a lot of companies that manufacture their servers. Their margins have also been improving. So in a way, it's been a positive ecosystem, not only for NVIDIA, but for some of the supply chain companies involved with them.
Okay, Frank, appreciate it. Frank Lee of HSBC helping us cover NVIDIA. Shares pre-market up some 6.5% on that beat. Okay, Manis, let's get to some of the other top stories trending on the terminal. There are other stories today, if you can believe it. The insider trading case against hedge fund Sengante Capital and its founder, Simon Sadler, is said to be moving to a higher Hong Kong court that can hand out longer sentences. The court can impose up to 7 years in prison for convictions. It's one of the city's highest profile insider dealing cases.
Alibaba is said to be considering selling a convertible bond to raise $5 billion. The sale would help fund share repurchases and boost growth. This follows a $1.75 billion offering by its rival retailer JD.com this week.
China held the biggest military drills in a year around Taiwan. That happened just days after Lai Ching-te was sworn in as president. Taiwan deployed sea, air, and ground forces in response.
Coming up later, we'll catch up with Matt Maley of Miller Tabak on why he sees limited upside for this potential rally.
And BHP has an extra week to convince Anglo American on its $49 billion takeover plan. More of that coming up here on Bloomberg Brief.
Now is the moment for Britain to choose its future. To decide whether we want to build on the progress we have made or risk going back to square one with no plan and no certainty. Earlier today, I spoke with His Majesty the King to request the dissolution of Parliament. The King has granted this request, and we will have a general election on the 4th of July.
UK Prime Minister Rishi Sunak there telling the UK that now is the time to choose, as quite the scene as rain fell on him and music, which happened to be somewhat of a Labour anthem, blared behind him. Also there near Rishi Sunak was our very own Lizzie Burden, our UK correspondent, who's now outside of Westminster. So Lizzie, I mean, there's really no precedent for this, having a prime minister call for election when they are so down in the polls. So why choose July 4th as the date for the election?
And why on earth would you choose it when the rain was coming down like it was, Danny? Rishi Sunak down and out the front cover of the Daily Mail newspaper, the Daily Mirror newspaper this morning. Look, there are three main reasons I would say that he's gone for July the 4th. First of all, he picked the day to call the election when inflation hit 2.3%. In his words, that's back to normal. And so he's going to present himself to the electorate as the Prime Minister that turned the economy around after Liz Truss. They've also had sight of the latest public finance figures, which would suggest there's not a lot of wriggle room for more tax cuts before an election in the autumn. And then, of course, he'll have had an eye on the poll lead of Labour's that only keeps widening. Some polls show a 30-point lead for Labour. So Sunak trying to put a plug in that before it gets any worse. But for Keir Starmer, the opposition Labour leader, now he's got to turn those polls into votes. And because of the absolutely atrocious performance of Jeremy Corbyn, his predecessor in 2019, he has got on his hands the biggest uphill battle since in the whole of the post-war period. I've just been speaking to a man who's taking bets on this election already. He's at Betfair Exchange. He's just over there. He's got the odds on a Labour majority of 2-9, no majority 11-2, and a Conservative majority at 33-1. So it's most likely that you'll get a Labour majority, but actually he tells me that they're taking more bets, not more money, more bets on no majority. So clearly people think it's worth taking a punt on Keir Starmer not doing as well as people might think.
He's certainly going to need a fair win behind him from the Bank of England. You know, pocketbooks matter. The CPI, he chose to announce when CPI was coming back, in his words, back in line. Do you think the table is set enough for the Bank of England to cut in June? They're very unlikely to do that ahead of an election on the 4th of July. They'd be accused then of politicisation.
Of course they would be accused of politicisation. The optics are inescapable. The old lady of Threadneedle Street helping the government. That's not the look they want to go for. I was just speaking to the former Bank of England policymaker Michael Saunders here on the Green in Westminster. He said the reason they won't cut in June is the data. It's not because of the election, but the reason they'll factor in the election is that now a June cut's not priced by markets. They're not going to want to add to volatility by making a surprise cut.
OK, Lizzie, thank you very much. Great work down there on the Green outside Westminster. Lizzie Burden. To BHP, they have won an extra week to convince Anglo American of the merits of their $49 billion takeover plan after a month of rising tensions. The companies are holding talks. BHP raised the value of its proposal for a third time earlier this week. So we're counting down on this. There's a week to go. Our senior editor for energy and commodities, Will Kennedy, joins us now. So is this a kind of a fill or kill moment on this deal? What is it that BHP are going to have to do in the next 7 days to bring it over the line? Will, good morning.
Good morning, Manus. I think we've got to a stage where perhaps price isn't the big issue here. The first two BHP bids were called undervalued by Anglo American in their response. It was notable that they dropped that language in their response yesterday, and talking to people who are close to this process, these seem to think that the companies probably aren't that far apart on the valuation of Anglo American. So now they're actually talking for the first time over the next week. What are they going to be talking about? I think the sticking point, and we've talked about this a lot the last few weeks, is South Africa. The complication of demerging these two South African businesses from the Anglo structure, Amplat's the platinum miner, and Kumba an iron ore miner. And that is difficult to do. BHP want it to be done before the merger can go ahead. And I think a lot of the focus is going to be on the mechanics of that and whether it's actually feasible. It's interesting that there's still quite a lot of skepticism that this deal will actually happen. If you look at the share price, which you just flashed up on the screen there, Manus, it is well under the latest BHP offer. So it's getting closer, but I don't think that we should feel like it's done.
Okay, Will, thank you very much. A week to see what happens. Will Kennedy there. All right, Manus, some breaking lines. At the top of the hour, we got the Eurozone's negotiated wages. They rose 4.7% year over year in the first quarter, Manus. Not only is that a pickup from 4.5% the prior quarter, but this matches a record that is set. This is a problem for the ECB, which only in a few weeks is supposed to cut, and wages are moving the wrong direction.
And this goes back to what Lagarde actually said yesterday, which was that she sees a June cut with inflation under control. Her words, there's a strong likelihood of a move next month if the price holds. But of course, these negotiated wage deals, what portion of that is in Germany? What portion of that is in other countries? So does it undercut June? Well,
the thing is they broadcast June so much. You can see markets aren't moving hugely. We showed a euro that's up only about 0.1% because perhaps this market knows that they're going to go in June regardless. Manus, I think this throws into question what happens after June. Can you really cut continuously if this is what the wage picture looks like? Okay. Coming up, we got to talk about Taylor Swift. She's never far from our minds. Remember when she prompted a bunch of economists to upgrade Singapore's GDP? This time she's got a Europe effect going on. More on that next. Context Matters on Bloomberg. It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. All right, let's get some front pages for you. Look at what's making headlines around the world. So this one you saw, Manus. It was on the New York Times. So Nikki Haley gave her first public appearance since dropping out of the race and said not necessarily an endorsement of Trump, but that she would vote for Trump in the November election. Is it enough to bring voters under the Trump umbrella? Not necessarily clear. I mean, as far as endorsements go, this was a pretty weak one. I don't even know if we can call it that.
She was still polling quite well. You got to ask yourself, what's the subplot in terms of politics for Nikki Haley coming out and actually saying that there's a race on for various positions in that administration, if that is the administration that comes along. Now, Bloomberg, this is one that Danny and I have touched on a couple of times. FINRA doesn't want to take the blame for getting you back into the office 5 days a week. The regulator says, look, if anything, the announcements that we're going to make over the next couple of weeks is about giving more flexibility. So this is, as you say, setting the stage really, there's carrot and stick, but this is about a stick from employers. In other words, if you don't come back, we're going to know you're not here.
Right. Well, this is off the back of Barclays saying, according to people familiar, you need to come back in 5 days a week if you fall under FINRA rules, and basically blaming FINRA. Man, as I said this yesterday, I say it again, I think it's an excuse. Barclays is going on a big cost-cutting program, £2 billion. What better way to cut costs than to weed out employees who don't want to come back to the office?
Indeed. It's a little bit of fear, and as I say, the carrot and the stick, and there's more the stick. Now, no show's complete without a bit of Taylor Swift and her economic impact. We saw it in Pittsburgh, we saw it around the world. This time it's in Paris. This is Bank of America data. They're spending like billio when they went to Paris. Bank of America data showed they spent 22% extra. So get ready, London, Milan, and Vienna.
No, we're going to have to ask central bankers about this again.
Yes.
Powell's going to get another Taylor Swift question. I think that's where we're going.
The inflationary effect of Taylor Swift can't be denied.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
No sign of slowing down. NVIDIA adds $140 billion to its valuation in post-market trading after crushing the outlook and expectations. Treasuries steady after a post-Fed minutes decline. The latest log shows the central bank is in no rush to cut those rates. And the U.S. Justice Department plans to sue Live Nation this week for antitrust violations related to Ticketmaster's monopolization. Danny, good morning. What have we got? I mean, it's almost like Oprah Day for NVIDIA.
You get a dividend, you get a dividend. Check under your seat. There's a 10-for-1 stock split. That is what we got for NVIDIA. That is the story of the day. Who cares about Fed minutes? Who cares about central bank speech? You have NVIDIA up some more than 6.5% pre-market, on track to add nearly $160 billion to its valuation. Futures up 0.5%. 10-year yields unchanged this morning, 4.42%, a little bit weaker yesterday after Fed minutes showed that members of the committee were willing to discuss hikes if the data warranted, something that Powell seemed unwilling to do. I also wanted to put the yen up here. Little change this morning. It's at 156. Man, so I wanted to put this up here because JGBs are now above 1%. The yield is back above there. We've had that. We've had huge amounts of intervention, $60 billion. We've had a reduced bond buying program. And yet the yen is unchanged. There's just not much that authorities can seem to do to juice this thing. I mean, they've thrown everything at it.
Well, the debate becomes what happens next from the Bank of Japan in terms of monetary policy response. And the betting has moved from, 14% of a rate hike in the summertime to now over 60% probability, Danny. And therein lies the point. If you're at 1% now on JGBs, if there is a rate hike in the summertime in late July, what is that going to do? What is the momentum? And then there's the whole repatriation trade as well for domestic investors in Japan.
Yeah, but I do think a lot of this comes down to trajectory of the dollar, too. We know that this is a big part of it. But also, if you have the Bank of Japan potentially making moves, if you have euro area wages, I'm going to come back to this data, Manus, at 4.7%, are rate differentials really going to be as wide as we once thought they were?
Well, the carry trade has been the prime sort of stake in the markets at the moment, so we're going to keep an eye on those. We can't get away from NVIDIA. It was 140 billion at one stage last night, 160 billion this morning in terms of market cap that's been added, as you said, Danny. We've had HSBC upgrading, staying with their buy at $1,350. They shattered all expectations for their earnings, showing that artificial intelligence is here to stay. The CEO, Jensen Huang, spoke about the optimism on the earnings call.
The industry is going through a major change. Let me give you some perspective on the importance of the transformation. The next industrial revolution has begun.
It's begun, Tom. Tom McKenzie joins Danny and I now. Tom, we just caught up with HSBC and the analyst there. He's got a buy rating on the stock up at over $1,350. He said it wasn't a massive beat, but it was about the roadmap and the trajectory forward in terms of the growth potential. And that's the alpha in these results.
Yeah, look, you scour through the analysts' recommendations or at least responses to these results. It's hard to find anything negative. Look, the top line was that the first quarter they came out with a beat, 26 billion or thereabouts in terms of revenue, triple year on year for the first quarter. But more importantly, arguably, was the forecast around this quarter, the second quarter, 28 billion US dollars. And to your point, this is a company that, of course, still gets 45% of its revenue from the hyperscalers, so the Microsofts of the world, the Alphabets of the world. And there was a response to that dependence on those companies from Jensen Huang saying, we are pushing into other areas. We are placing other major bets, whether that's building out their own computers, building out the services, building out the software. It is something that they are adding to, and that could be a further catalyst. Then you have the 10-to-1 stock split that Danny was mentioning, and by the way, that 150% dividend increase, and the upside is coming through after hours.
All right, Tom, thank you very much. That is Bloomberg's Tom McKenzie there on the big old rally. Again, we're up some 6.6% in the pre-market trade. For more on how the overall market is reacting, let's get over to Matt Maley, Chief Market Strategist at Miller Tabak. So, Matt, here we go. Another blowout quarter for NVIDIA. We were talking to Franklin earlier, who said it's not as big of a beat as it has been, but it was enough to juice the rally. It's enough to juice the rally for NVIDIA, Matt. Is it enough to get the overall market excited and another leg higher in this market?
Well, it certainly could be, Danny. The one thing is that it's kind of weird because 6% for any other stock would be, unbelievably, this is fabulous. 6% for NVIDIA, still very good, but maybe not as good. I mean, but this time last year, the stock rallied 28% off of their earnings on the first day. It was just unbelievable. And we do have to guard a little bit against about what happened in the August their August report, where the stock rallied about 11% initially and then closed the day unchanged. So we ended up getting a sell the news reaction. But right now, things look very, very good. I mean, it's one of the things that's very interesting. We hear about this 10-to-1 stock split, which means that more people can, especially the individual investors, can buy the stock. But it also means that their options are going to be a lot cheaper, and it makes their options a lot more accessible to the individual traders. In the longer term, that may bring about more speculation that we won't necessarily want, but it's also going to bring about some near-term demand that can help the stock as we move through the end of the rest of this quarter.
Listen, I suppose in part, it's that they did not disappoint. They did not miss. The guidance was strong. And it's one of those sort of evangelist moments in markets. Right. I like what Andrew Simmons had to say, and I want to get to know whether Danny wants to know whether you're going to tilt towards your bull or your bear that's behind you. So on the next answer, it's all about the body. It's all about the body language. Full bull. Andrew Simmons over at Morgan Stanley. I like what he says. He says, we got this fear and greed momentum in markets, and where we are right now is record high after record high, 24 record highs in equity markets. We are in FOMO. We are in fear of missing out, and that is what will drive a movement in liquidity more into markets rather than a drop in rates. Does that make sense to you? I mean, we have reasonable earnings, and we have this NVIDIA moment, which was almost a macro moment. Do you think we're in FOMO? Do you think we're moving towards greed or fear?
Well, I mean, the FOMO is an important issue, and it's not just, some people think, again, it's the general public. Everybody just worries about missing out because, they're at their Memorial Day cookout and they say, geez, I'm missing this move with NVIDIA and stuff. The real FOMO comes with the institutional investor, because they're measured every single year. I mean, if an individual investor lags behind the market, they can't fire themselves, but institutional investors can be fired. So, they have to be they have to be there. If this market starts running, they're going to chase it. So that's going to be very important. But it's one of the things you did bring up that's very, very important is that earnings are good, but they're not spectacular. I mean, there's been no increase. There's been a mild increase over the next 12 months, but full year 24 or full year 25 have not been increased, and the market is expensive. And so remember last year we had a 25% increase in the stock market with zero gains in earnings. Okay, so the market's up 37% since the beginning of 2023, and earnings are up about 10 to 11%. We need even bigger earnings to really justify that. So we're really going to have to see interest rates come down. And everything we hear from the Fed right now is that they're not going to come down a real lot in a real hurry. So that does create a bit of some headwinds as we move through the summer months.
Matt, I have to say, it is remarkable how people can look at the same set of data and come with different conclusions. We were just talking with Coco Agablu of SocGen yesterday, who said that earnings were strong enough to justify the price increases. Matt, I feel like you're almost a contrarian in this, because we also see just this huge momentum around excitement in this market. You see positioning that's moved from neutral to outright long. Citi has called it a one-sided market. Goldman Sachs says that their risk appetite indicator is the strongest since 2021. Do you fear the one-sidedness of this market right now, if what you say is indeed true, that earnings are not keeping up with the price increases we've seen?
Yes, I do. And I mean, we all know that bullishness is good until it starts to get to extremes. And we're also looking at a market that's overbought on a technical basis, whether you look at the relative strength index and other readings. So it does become that concern. And I guess the other thing that I worry about is that people saying, well, don't worry, this is not like it was at the end of 1999, early 2000. Well, we don't have to get to the extreme, those wildly bullish extremes that we saw at the biggest bull market in history, for it to be, something that to be concerned about. So yes, I'm very, very worried about that. And the thing is with this whole thing about earnings is that, excuse me, the whole thing about earnings is that, we had zero interest rate, zero growth last year. And when people say that they're getting better and they're strong enough, 21 times earnings, I'm sorry, but every single time we've gotten up in that 22 times earnings, and we're also at 2.8 times sales, those are things that are followed eventually by a strong pullback in the market. So that may not happen immediately, but it is something we do have to be concerned about. I know everybody says it's different this time, but I just don't. I've been doing this a long time, and it never seems to work out that way.
So you're not a buyer of the AI productivity dream paradigm shift?
No. No. To be answering your question, it sounds good, but I heard that back during the internet bubble, and that was a much bigger bubble. But So
you're saying we're in a bubble?
Always these innovations.
Are you saying we're in a bubble?
World. I'm sorry.
Are you saying we're in a bubble?
No. I just say that if we are, the biggest thing that we do have to worry about, man, is that we need to see this whole earnings growth shift from the picks and shovels to the end users. And so far, we're really not seeing that. If anything, we're seeing people warn about, trying to pull back expectations a little bit for the real end user. So it really does broaden out in a much bigger way. It's broadened out only slightly. We needed to see much bigger to justify these kind of run up in the market. And we do have to remember that this excess liquidity. Remember, in the late 1990s, we had a big increase in liquidity because of the Y2K issue. Last year we got a big increase in liquidity because of the banking crisis. This year we have fiscal liquidity. If that starts to run out at some point, maybe it doesn't happen until after the election, but liquidity is still a key role in this marketplace, and we have to be careful.
Matt, just quickly here, because you mentioned the broadening out, that it's been minimal. The way it's broadened out is strange. It's gone to things like utility stocks that are now an AI play. I know you look at nat gas because some of its AI attributes. What does it mean in a world where sectors are starting to get mixed and matched and confused? Can I, for example, still look for utility for safety, or if the valuations do come down and what you're talking about, the overvaluations, do I need to be fearful for literally the impact on every single sector this time around?
Well, no. Yes and no. I mean, like anything else, when the overall market, the problem, of course, is that it's so highly concentrated. This rally, even though it's broadening out slightly, if you start to see these big tech names go down, I mean, the tech sector is, not just the Mag 7, but the entire tech sector, 53% of the Nasdaq, the NDX 100, over 30% of the S&P 500. If they start to go down, the whole market's going to go down. We're not going to continue to rotate. If they guys start hitting hard and the indexes start getting hit hard, people are going to start calling the 1-800 mutual fund and start shifting some of their money into cash at 5%. But thankfully, these things like the natural gas stocks getting a little overbought. Same with utilities, overbought on a technical basis, so I don't want to chase them here. But they don't have the kind of huge valuation premiums that the tech sector has. So there's still going to be some safety there. It's just you're also going to get hit a little bit, just not as much.
Matt, I've got that number punched into the dial now. 1-800 mutual
Goes
fund.
straight to Miller Tabak, that number.
Straight to Miller Tabak. Get me into cash, dude. Get me some CDs. Matt, thank you so much. Matt Maley over at Miller Tabak. Coming up in the show, Live Nation. It's falling as the Justice Department moves to sue the firm against merging with Ticketmaster. More on the story. Context matters on Bloomberg. It's Bloomberg Brief. I'm Manish Rani alongside Danny Berger in New York. And a Bloomberg scoop for you. The Justice Department and several states will sue to try to break up Live Nation and Ticketmaster. The shares are tumbling on the back of the news. Alex Webb joins us now. I mean, they have been warned before under the Trump administration to sort of improve their behavior. Now the Biden administration is going for a full lawsuit. What is the monopoly case?
Well, actually, it seems as though this isn't really a monopoly case. This isn't to do with consumer pricing. This is to do with how the suit will reportedly allege that they force venues to sell their tickets through their platforms. It's actually what's known as a monopsony case, which is something that Lena Khan over the FCC, this is a DOJ case, the FCC has been a real champion of. That's when you control the marketplace so you're the only place that people can sell their wares. So that is something that she thought about, particularly when it applies to, say, Amazon. You know, if you think about Apple with the App Store, Google with their App Store, those are potentially perceived as monopsonies. So that's what this is really focusing in on. And yes, the results could be anything from fines all the way through to a full breakup.
Monopsonies. It's not the easiest thing to say, Alex. To Manish's point, there have been other cases that were taken on the DOJ, the FCC. I mean, this is a regulatory environment where we are seeing more pursuits of antitrust. So how does this specific scoop from the Bloomberg team compare to the cases that are already ongoing?
Well, again, this is actually a similar sort of thing that we've seen elsewhere. The real big one, actually, precedent for this so far is Simon & Schuster, right, which was, put up for sale by Paramount. It was other publishers trying to buy it. That was perceived not as giving them pricing power over book sales, but pricing power over authors. So that if you're a big-name author and you're trying to secure a big advance for your next tome, you have fewer places to go to who can bid against each other. So that's actually why that deal was blocked as well, and Simon & Schuster was ultimately sold to KKR. So it's fascinating. They're really going hard after this. We haven't, in comparison, seen quite as many monopoly cases. So I'm going to be following this with bated breath.
Yeah, and we look forward to have you on as you follow it. Again, interesting that it's not necessarily preventing a deal. This time it's about breaking something up. Alex, thank you so much. Alex Webb. Okay, let's get you a quick check on DuPont shares. Up in the pre-market trade, about 5%. The company announced that it's going to be splitting into 3. And the CEO, Ed Breen, will be stepping down. Joining us now is Bloomberg's Kriti Gupta. Kriti, what are the details here?
Yeah, Danny, this is a utilities/industrial company, a company that does a little bit of everything, but the history of this company is so important, specifically with Ed Breen at its helm, who's kind of known as a man who puts together portfolios of companies, then kind of takes them apart. This is not a new story and a new strategy in terms of splitting these companies. Danny Manis, and when you're looking at some of the details here, they're separating the electronic and water units through some of these tax-free transactions. The goal here simply being they're going to make DuPont a strictly industrial company. The new DuPont will simply be industrial. But this is a guy, Edward Breen, who will be stepping down on June 1st, still staying on as chairman, handing over the reins to his CFO. And what he's kind of been doing here is spinning out a lot of these companies and separating them so they're trading a little bit more closely to their multiples and having a more clearer focus. That's a strategy that's really appealing to their shareholders, at least in the pre-market.
So this is about the conglomerate, the weight of the conglomerate discount and about the sum of the parts, the narrative about breaking it up. It's as old as time. But is there a broader market trend? Are we seeing other companies take the same road?
Yeah, splitting apart companies seems to be the new normal, man. As you saw it with J&J, you saw it with United, you are seeing it with several companies because it's proving to be so profitable when you do it, not only to shareholders, but because of the accessibility to a lot of these companies, because it's not that kind of merger and acquisition driven portfolio, it's a more clear vision. That being said, again, this is a very Ed Breen specific strategy. He was actually known, this is his second iteration of being CEO. In his previous iteration, he was responsible again for the spin out of DuPont and Dow Chemical, for example, some of the biggest industrial names that we don't necessarily pay attention to every day. This is a strategy that's worked for this company time and time again.
Kriti, thank you very much. Great upsum on the DuPont story there. Kriti Gupta on the US equity story. All boats are rising on the back of this $160 billion bump that NVIDIA has had through the morning. Danny, can it hold? It's a very interesting proposition. We've had a number of conversations on it. It's for HSBC, it was very much an inline set of numbers, but it was about the roadmap ahead. And then, of course, you've got TSMC spending all the capex for you. So, you are essentially a capex-light, intellect-heavy company. It's nirvana. I mean, 75%, again, if you are a semiconductor company, that for margins is crazy. If you are a capital-intensive company, you should not have 75% margins. But NVIDIA has it, in part because of the TSMC story. And Frank Leet of HSBC talked about this. They're widening the net. They're widening the tent. It's not just the hyperscalers. It's Dell. It's enterprise companies. They are shifting their model. It's about a faith and belief that they can deliver in that enterprise value. They've gone for a stock split, 10-for-1. That is democratization of equity. Or, as we also heard, from Matt, it is about volatility now as a result of that stock split because of the options trade. Yeah, it makes options a whole heck of a lot cheaper. I think that's so fascinating. Okay, coming up, host of economic data is on the deck. We'll run you through that. Context matters on Bloomberg. Good morning from New York. It's your Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. Let's get you set up for your trading day on this Thursday. G7 finance chief and central bankers will kick off a 3-day meeting in Stresa, Italy. Janet Yellen was just speaking there. Then in the U.S., initial jobless claims come out at 8:30 a.m. Eastern, PMI at 9:45, and new home sales at 10. Then $16 billion of 10-year tips. Those go on sale at 1 p.m. Manus, what you got in those stocks? Oh, guess what? Let's just close off with a little bit of NVIDIA. Surprise, surprise. Surprise, surprise. It's a bit like Oprah Day for the chip stocks. Up $160 billion. Let's see where it ends. You've got a stock split coming through on that as we just had a conversation. A little bit more volatility may come. Dell is up 5.25%, riding this AI wave on the NVIDIA results. And Bloomberg Intelligence says that NVIDIA's robust enterprise data centers results will boost the confidence that Dell can boost their overall guidance. And then you got Snowflake extending their post-earnings gains. They see strong growth. And guess what? It's all focused on the AI product. Shocker. Bad day to not be an AI-related company, which apparently everything is these days. Just to go back to the idea of the options thing that Matt Maley of Miller Tabak was talking about, because I think this is a point that I honestly didn't think of, and I think it's really interesting. Not only are the individual shares now cheaper to buy because of the 10-to-1 stock split, but now it's so much cheaper to trade options on this thing. If you think about how the options market has evolved, it's a lot more retailers, retail traders using options to make specific bets. But we can see how that can go really wrong. Think of Palo Alto shooting up and then crashing down. Is that NVIDIA's future if they now can have cheaper options? Well, I think, and the price reaction today, as we say, okay, $160 billion is not to be sniffed at in terms of the reaction function. But if you take your mind back to other earnings releases where it was much, much bigger upside, but the outlook from HSBC is still that the roadmap for the Blackwell platform is strong, and you've got to have the faith and belief that they can move beyond the hyperscalers. I have faith and belief. You know, it's the godfather of AI. Get the popcorn out, as Dan Ives says. I was going to say, Dan Ives, you know, he's a believer. There are many believers out there. You can see it in the stock price, up more than 6.5% this morning.